Uncertainty over a trade deal with China has impacted the markets again today. The White House officially announcing the Treasury Secretary Steven Mnuchin and U.S. Trade Representative Robert Lighthizer will lead negotiations in Beijing next week as the two sides attempt to get closer to a deal. This comes as sources tell CNBC the March 1st deadline to negotiate a deal may get pushed back. Mike, back and forth always on whether it's good news or bad news. Do you frame this now as the market has more to fall if it gets meaningfully worse than it has to gain once we get the announcement of a deal?
I would say meaningfully worse, yes. I think messages of flexibility or trying to find the makings of some kind of a deal are probably a net positive, but I don't know how much we're kind of spring-loaded to move higher just if we get a deal. And I do think, obviously, if it ends in hostility, if it ends in an increase in tariffs, that's not a good thing. But again, we've been living with it for a year. I feel as if we've kind of worked through what the potential implications are in both directions, and I think it's all a matter of what the market field position is going into that decisive moment.
Yeah.
If we're up another 5% from here and everyone thinks it's a done deal and we don't get it, then we have downside risk.
Buy the rumors, sell the news. Jim, how much of the weakness and the slowdown in earnings that we're reporting on every day has to do with this trade war?
I don't think it has to do so much with the trade war. It has to do with the deceleration of growth in China. So if you look at equity markets,
isn't that because of the trade war?
Well, I mean, trade is part of it, and the trade war is part of it, but what you're seeing is the Chinese economy is slowing much faster than anyone expected. And that was the news that we really got in December of 2018. If you look at PMI, you look at any of the leading indicators in China, I mean, they're not quite crashing, but they're as close to crashing as we've seen in some time. And it's really because Xi Jinping, the president of China, has had policies that have favored state-owned enterprise over free enterprise. They're going backwards, not forwards. And when I talk to my Chinese counterparts and I talk to entrepreneurs in China, they're getting frozen out. And even in the last couple of months, with that rapid deceleration in growth, you're seeing the government take some steps to actually free up credit for entrepreneurs and free market activity. And I think that's a positive sign, but it might be a little bit too little too late.
So Jim, whatever the cause of the equity of the company's guidance downgrades for the year ahead and earnings growth therefore being a bit lower than we had expected, are S&P multiples too high?
I think if you have to bifurcate. If you look at tech stock multiples are clearly too high, and I think that explains a lot of why U.S. markets have outperformed international markets. It looks a lot to me like 1999, where you had a period of time where both the U.S. stocks and tech stocks dramatically growth outperformed value, U.S. outperformed international stocks, primarily because tech drove both phenomenon. I think if you look back for the last 5 years, it's been the same case. It's very difficult to get excited about Amazon at a PE of 78 on a backwards-looking basis. So I think tech has very little room to sort of rise. I think most of the news coming out about tech is going to be mediocre. And I think they're going to fail expectations. So if I look at value stocks, I look at banks, I think there's probably some more room to run. But if I look at what's been driving the market higher, it's difficult to see how multiples expand further.
Just want to quickly hit on two other themes this week, which was strong dollar and strong small caps. The two tend to move together often.
Yes.
When the U.S. does better than the rest of the world. Is that going to be a longer-term phenomenon here?
I would not extrapolate it just from 1 week. You know what I mean? I do think it's the reflex. It makes sense in that context. If the dominant storyline is let's worry about how much the rest of the world might be slowing down, but to me, it's not necessarily something that I would say, let me draw a line here. Now, the market, I mean, the dollar has stayed very well supported. There's no doubt about it. Even when it's had these dips, it's not really been that significant. So that part of it might hold up. I just don't know if this is going to be a small cap year.